A question everyone must answer in investing is, how much to invest? Some people are risk adverse. They save all money in banks with no investment. They may not know how to invest or may be afraid of the question, what if I lose? They try to be safe, but unfortunately, their wealth is simply gradually eroded away by inflation and expenses. Some people are risk-prone. They put all money in risky assets or even max out leverages. They think about becoming rich through investment every day and are nervous about the question, what if I miss? They try to make money, but unfortunately eventually get wiped out by huge market volatility and unexpected price movements. So, are there alternatives? Can we invest the right amount to achieve long-term growth of wealth? The answer is yes. To further explain this, we can use cryptocurrencies as a good example. Crypto is exciting and dangerous. Prices can fall 90%, then rise 10 times, then crash again. Some traders make life-changing money, but most lose everything. The difference isn't just luck or better predictions. The real difference is position sizing. Even predictions with high accuracies are worthless without the right bet size. Go too big, and one loss erases years of gains. Go too small, and compounding stalls. That's where the Kelly rule or Kelly criterion comes in. Originally developed for gambling, it answers the critical question, how much to allocate to maximize long-term growth without risking ruin. It doesn't try to predict markets. It explains how wealth grows or collapses under repeated risk. And in crypto, this matters more than almost anything else. This video builds an intuitive understanding of Kelly rule, no math needed. It shows how using just a small fraction of capital in the right way can lead to huge long-term gains, even when prices go nowhere. Let's explore why. Suppose prices crash 90%. It feels like all hope is lost. Then they rebound 10 times. Anyone who's in crypto long enough has seen this. Now imagine starting with $1,000. Half goes into Bitcoin, half stays in cash. So $500 in Bitcoin, $500 in reserve. A 90% crash hits. Bitcoin drops to $50. Total wealth becomes $550. But this is the critical part. The investor rebalances. He restores Bitcoin to 50% of total wealth. That's $275. With only $50 left in Bitcoin, he uses about $225 from cash to buy much more Bitcoin at the rock bottom. Then Bitcoin rises 10 times. That $275 becomes $2,750. The untouched cash remains at $275. Total wealth becomes $3,025. From the original $1,000, it tripled, even though price just returned to where it started. Why? Because buying low and selling high happen automatically just by sticking to a simple 50% rule. It's not a one-time trick, it's a system, a compounding engine. 10 such opportunities can turn $1,000 into $60 million. You may not achieve this in a short time, but you can definitely achieve this in a lifetime. Now imagine going all in, no reserves. The $1,000 drops to $100, then up 10 times back to $1,000. Big swings, big pains, and zero growth. The market gave an opportunity, but without reserves, it was wasted. That's the tragedy of most traders. They FOMO in, they panic sell, they miss the rebound, they think the market is unfair, but volatility was a gift. They just weren't ready to catch it. The Kelly rule is how to be ready. It's not about winning every time. It's about surviving and compounding over time. It says, don't risk more than a calculated fraction of your wealth, usually far below 50% for any one asset. That fraction leaves room to buy low, ride volatility, and avoid being wiped out. It's not magic, it's math, but it feels like wisdom because it lets traders stop gambling and start compounding. You don't need to time the top. You don't need to predict pumps. You just need to be consistent and resilient. Unfortunately, Kelly rule is very hard to follow because even knowing the math, people still go all in, panic sell, and overreact. Markets don't just test intelligence, they test emotions. Every pump whispers, this is your chance. Every dip screams, get out before it's too late. It's one thing to know the math. It's another to override the fight or flight instinct when your money is on the line. This is where most traders fail, not in strategy, but in execution. Even those who study risk models fall into the same trap. They increase size after a few wins, just before a big loss. They shrink exposure after a loss, missing the next rebound. They change allocations constantly based on emotion, not method. Without structure, discipline to follow the rule collapses. That's why I built Quantering Trader, a free tool to turn Kelly discipline from theory into habit. Instead of placing specific buy and sell orders, which require decisions driven by greed, fear, and pressure, Quantering Trader lets users set target portfolio states. You decide the percentage of wealth you want in each coin. Then the program follows those targets rationally by monitoring the market and rebalancing when needed. No timing, no guessing, no emotional execution. It's a fundamental shift from trading by volatile actions to trading by setting stable target states. So the system handles the chaos, not your nerves. Here's how it enforces discipline. First, users set a maximum allocation cap, say no more than 20% of wealth in a coin. Even if you drag the allocation slider to 100%, that only means 100% of your allowed 20%. This prevents going all in even during hype. Second, the video layout helps reduce tunnel vision. You can monitor multiple coins and time frames at once. This broader view discourages chasing one asset blindly. Third, it supports automatic rebalancing. Users can set conditions based on indicators, so the program systematically buys low and sells high, quietly compounding in the background. Together, these features make QuantaRing a calm, logical environment for executing a smart strategy built around the Kelly rule. It's free to use. You can download it from the link in the description or comment. In summary, crypto markets are volatile. That's not the problem, that's the opportunity. But most traders let emotion sabotage them. The Kelly rule offers a better way. Allocate moderately, keep reserves, let compounding work. This is how small consistent wins become exponential growth. And if you want a deeper mathematical breakdown of the Kelly criterion, I made another video that walks through the formulas step by step. You can check it out from the link on the screen or in the description. When discipline is combined with the right tools, like QuantaRing, it becomes much easier to follow. So, if this helped clarify things, if you want to build your portfolio with math, not emotion, subscribe. Like the video if it sparked new insight. Comment to share your thoughts or ask questions. And feel free to check out QuantaRing in the description. It's completely free. Thanks for watching, and may your wealth growth be calm, compounded, and unstoppable.